Test 1, 2. CIO John Grable, DCEO Jude Perez, Senior Investment Officer Terry Harrison, and we have Margaret McKnight from Stepstone. And we may proceed with the agenda.
Okay. Then let's go to, since we don't have a quorum, we'll pass over the approval of the minutes until we have a quorum. Do we have any public comment?
None.
None, okay. And then let's bring up Terry and Ms. McKnight, AKA Margaret, for our real estate update and education. Our dynamic duo of real estate.
Good morning.
Good morning.
It's our pleasure this morning to present this real estate update and education. You will hear little from me in the beginning. I am very pleased to turn this over to Margaret McKnight, who is a partner at Stepstone and works with us on our real estate education program.
It'll be good as long as I can turn the mic on.
Yeah. Yeah. There you go.
Now it's good.
Yeah.
Okay, I was looking for the green. Okay, so hello, I've been working with your team for several years and it's been a real pleasure, and thank you for this opportunity to talk a little bit more about the asset class. I am the head of portfolio solutions at Stepstone Real Estate. Maybe we could page ahead to the page with my photo on it. And there we go. I work across our business and our team on top-down portfolio strategies. And as part of that, I also oversee our house views process, which I'll talk about in a bit. Next page, please. So why do you have real estate in your portfolio? Real estate actually does 4 useful things. There are some things that are only in there for return. Real estate is different. In its simplest form, the overwhelming majority of the return from real estate comes from current income, which is very important to mature pension plans because they have to regularly pay out benefits. And for this reason, most mature pension plans have a significant investment in real estate, as do life insurance companies. The second reason is inflation protection. Now, real estate will do a decent job of protecting you from garden variety CPI inflation, 3% everybody's been talking about, but so does the stock market. What real estate does that's different is that it can be very useful in times of significant inflationary shocks, which have been very destructive to large equity portfolios. It did a fabulous job of this in the 70s. It did an okay job of this. We had a second shock in 22. These are not common, but they can be devastating. So it is important. It serves an important role in protecting the portfolio over the long term. The third reason is diversification. And that means it acts differently than the other asset classes in the portfolio. It has low correlation. There's a statistical term for it. And this is a very powerful risk mitigator in your total portfolio. And then the fourth thing is attractive total return. Now, when you use the word attractive, you start to say beauty is the eye of the beholder. There are absolutely times when real estate funds can deliver mid-teens returns. So in that sense, it can be absolute return, but it also is seen as having attractive return per unit of risk. It is an opaque private market, and it is possible to have information advantage and take advantage of inefficiencies to generate more alpha. So this is why we have real estate in the portfolio and why we're having this conversation today. Next page, please. Real estate is an enormous market with about 13 trillion in institutionally held assets globally. On the left side, you see roughly evenly divided in the 3 major geographic regions. The right-hand side shows how it's held. And the interesting thing is they're all gray, the second bar up, which is the public part of the market. And the columns are US, Europe, and Asia. In total, only about 37% of institutionally held real estate is held in public stocks. So it's a minority of the market. And those stocks are part of the target universe of your equity managers. So they are not what we're talking about today. We're talking about privately held real estate. So next page. Of course, when you think about real estate, you think about location, but there's another major vector that is very important in portfolio construction, and that is property type. There are what we call the four main food groups: industrial, retail, office, and residential. Industrial is predominantly warehouses, which you see a lot of around Los Angeles because it's the biggest port in North America. Residential is predominantly apartment buildings. When we look at the institutionally held universe in the US, the core real estate is 2/3 industrial and residential. Industrial has grown enormously, and in last year's education presentation demonstrated that it's had very, very strong returns, and it has benefited from technology change and change of use. As e-commerce came along, demand for retail space went way down and demand for industrial space went way up. And that led to a big surge in the sector in terms of size and returns, which has mostly normalized at this point. There's another important secular trend led by technology and the use of how we use space and property types, and that's in office. When I started my career in real estate roughly 30 years ago, instead of being industrial and residential, it was office that was 2/3 of the portfolio. Now, at that time, there were also huge law libraries, file cabinets everywhere, Xerox machines as big as cars, and that is all right here now, right? So the demand for physical space in office buildings has been declining for decades. And the kind of final straw that broke the camel's back was the lockdown demonstrating that work from home was functional. That was really made possible because of technology change. So office is now comprising less than 20% of the portfolio and really sorting itself out as we figure out how we're going to use that space. But it's very important when you're building a portfolio and managing a portfolio over time to be aware of these trends in changing space use. And our house views is one of the ways that we monitor and share that with our clients. But you have to stay ahead of that so you don't wind up with obsolete assets. And the next page, please. I listed the major property types. There's actually subtypes of the majors, and there's a wide array of minors, and those have been increasingly institutionalized. And this is the major US core index is published by a group called NACREIF, and it's called the Odyssey Index. It's the open-end diversified core equity index. It's a funds index, and it requires diversification by property type. And these are the guidelines. You don't need to worry about those. It's just an interesting list. But what they've recently done is change the guidelines in this core safe portfolio to allow for more niches because they have become more mature. So the residential category is not just apartments anymore. It's single family homes for rent. It's manufactured housing. It's student housing. The life sciences and biotech space is now occupies some of industrial and office use. There's medical office. And then there's an array of other self-storage, senior housing, which is not in residential for a host of probably political reasons. I don't know. But that is getting really interesting now. In the US, we have the baby boom population, which is now beginning to turn 80. And that's when they start to use senior housing. And it's everything from active adult to skilled nursing. So there's a wide array of property type choices when you go to compile a real estate portfolio. And everyone actually plays out differently in different locations too. So the location and property type are two of the main vectors we think about when we are building portfolios. Next page, please. Actually, one more. So now we're going to talk about real estate strategies. When you are building a portfolio, as John does on the whole portfolio level, or as we do in the real estate department, we think in terms of risk return, and this is the risk return line. And on the lower end, you have strategies that are lower risk, that are expected to be lower return. And as you move up the line, you have higher risk. So you would expect or target higher returns from those. And when you're building a portfolio writ large, that sort of bottom end is debt and near the top end is equities, stocks, the S&P 500. Real estate and real assets actually sits between the two of them. As I said, it does really different things in portfolios. When you go to invest in real estate, unlike most other asset classes, it's not a point on that line. It actually occupies a big, long swath of that line. The bottom end is real estate debt, which for you is covered all over in fixed income. So this line is equity. At the bottom end, we have what's called core, which is well-leased, well-located, well-maintained properties that are performing really at their potential. And this is the category where the overwhelming majority of the long-term returns come from income. Sitting next to that is core plus, where you can take, it's still considered low risk. You can take just a little more risk. Maybe there's a little bit of leasing to do. Maybe it is a property with a lot of demand, but kind of a second best location or older. So core and core plus kind of sit together and confusingly are also called collectively core. As you march your way up the risk return spectrum, you are taking on more income risk. So value-added properties may have significant vacancy. They still have some income in place. And then opportunistic properties may have a lot of vacancy or be completely empty, like a gut rehab, or maybe a new development. So there's more and more operating risk as you go up this line. Now, the funny thing about real estate that is not in line with balance sheet management 101 is that as you take on more asset level risk, you also take on more liability or debt risk. So as you move up the curve, you have core leverage, which is targeted around 20%, and core plus, which is targeted around 40%. That makes sense when you have really solid, stable income. As you go up into the value add and opportunistic realms, you get more like 55 to 65 and even higher leverage. And that is how you can target in the value added and opportunistic range kind of mid-teens returns. And it's how you take a real asset, which really sits below the equities, and make it competitive from a return perspective. So this, and at some points in the cycle, you can actually deliver those returns. So we think of the world in terms of core and non-core is riskier with more risk around the return. And I'm going to keep going, but I want to take a second because I haven't paused for questions. I just realized.
And Mark, I was about to jump in here real quick. The back on slide 14, just a question about workforce housing. Some of the affordable housing may not be the right word for, but like in that kind of mix, are we seeing, is that part of the other? Is that considered part of the core?
It's part of residential.
Okay, so it is considered.
It is. Residential is a wide swath from a brand new, super expensive downtown tower to affordable workforce housing, to actually what we call capital A affordable housing, which is like Section 8 and government program supported, and it's all residential.
Okay, got it.
Interestingly, the most stable and therefore the best risk return comes from the more affordable properties.
Got it. Good.
Okay, so that's the risk return line for real estate. And when you're building your strategy, you need to think about what your goals were in the first section and meet that up with where you land on the strategy line. So the next page, please. Can we turn the page? Thank you so much. Okay, oops, one back. So just to put some numbers around this, and don't worry about looking at the left chart, I'll kind of read it out. I described the risk line, and over the last 20 years, stocks have delivered 10.7 and bonds have delivered 3.1. And then you see real estate at 5.5. It's literally right in the middle, which over the long term is exactly what you'd expect. And also I'll note that it's a very, very low, this 20 years is a very low interest rate environment. That's why you have the 3, the long-term rates, should be higher and are now higher. Now the interesting thing here on the return is that the core delivered 5.5 and the non-core delivered 5.7. If you take a longer window, 30 years, you get 6, 7, and 8.4. So a little bit more of a spread, but you're not getting paid very well for taking that extra risk in aggregate. Now that assumes you're buying the market. The chart on the right lays out the returns for the non-core real estate by vintage year, which is important. And I'll get to this later. The way they're held in closed-ended funds, the life cycle of the fund matters, but also real estate is very cyclic. And if you look at the little green dash inside those bars, that's the median, that's the middle return. That moves around because real estate's cyclic. So it's really important to know when you bought this non-core real estate. And if you're going to succeed at non-core real estate, there's a couple of things you have to take in mind. And the first one that it is a cyclic market, and market timing does help. It's hard to do. And so keeping a more stable allocation matters. But when you're making deployments, being mindful of where the market is also matters. If you want to get returns for that extra risk, as it happens, and I'll talk about this later, we are near a market bottom, so it's a good time to be investing in real estate generally. The other thing is these bars are really tall, and what these bars show is the spread of returns for the non-core managers. There's an enormous range of outcomes. So it is actually possible, as I said, it's a more opaque property type. It is possible to consistently outperform. Our track record does. The number of our clients consistently outperform in non-core, but it's hard. And it's hard because there is this huge spread of outcomes. So it's worth spending the time to get it right if you're going to do it. Otherwise, you're better off in this kind of core plus land. And I'll talk a little bit more about, there's another reason why you're better off there later. Okay. Questions? The one other point on this page is volatility is a measure of risk. It's a measure of how much prices move around. Real estate also sits between stocks and bonds in terms of volatility. That's the risk measure. So from return and risk, it sits between stocks and bonds. And then the Sharpe ratio is how much you get paid per unit of risk. And the stock market is 0.52. The Sharpe ratio for real estate is 0.37 for core. So you get paid very well, better than anything but the stock market in terms of each unit of risk you're taking on average, or you have gotten paid over the last 20 years. Okay, so that's the numbers. Next page. As I said, you want to think about your purpose when you're designing your strategy. So the strategies are across the top. If your aim is current income, you really want to stay in the core plus zone. If your aim is inflation protection, you do better in the core plus zone. And it pretty much all provides diversification. Opportunistic, because it's so highly levered, can get a little more correlated with the broader markets. But the strategy is determined by the purpose. Next page, please. It also defines the vehicle choices. So when you're owning a well-performing, well-leased, well-maintained asset, you basically want to hold it for income. And so you have this kind of long-term income-oriented strategy that's very well suited to an open-ended fund. An open-ended fund is like a mutual fund. So there is a portfolio of assets with a buy and hold strategy. It's actively managed. They're culling some of the weaker performers and leaning more into changes in demand so that they can continue to do well. But it's basically a buy and hold strategy. And whether the assets are bought and sold is a separate decision to whether you're investing or not, because you're just buying shares in that portfolio. And that's where most of your assets are, in the core plus zone in these open-ended funds. That is very different from the non-core, where you're buying something that's broken, fixing it, and selling it. That's really all about capital appreciation. And that tends to be best held in closed-ended funds like private equity, where a fund manager has a strategy, raises a finite amount of money, buys the assets, fixes them, sells them, and when they sell the asset, you get your money back. So it's all connected. And that's really the only way you get your money back in that sector is when they sell the assets. There's not a vibrant secondaries market for real estate fund interests for technical reasons, which is different than PE. So we tend to talk about those in vintage years, which you saw me do, because the life cycle of the fund matters. If you're just buying versus selling, your returns are going to be in a different place. And it's very IRR oriented, internal rate of return, because you're really focused on getting that big jump in value. Whereas the core plus is time weighted return, just like the stock market, because it's this long-term hold investment. So that's where the vehicles come in, which you'll hear about when you hear us make fund choices. Next page. LACERA's real estate strategy, you'll be gratified to know, not surprised, I hope, completely aligns with the purpose. The page that I've cut out on the right is from your structure review, and you have the 4 different categories of investments in your portfolio. And core real estate, and here I apologize, core real estate is 5% of your portfolio, okay, non-core is 2%. I flipped the numbers.
Thank you. Yeah.
The core real estate is part of the real assets bucket. So it's aimed at income and inflation protection, and it is benchmarked to the Odyssey Index. The non-core, which is 2% of your portfolio, is the higher risk, higher return strategies, and those are in your growth bucket. And those are benchmarked to Odyssey plus 225. So you're expected to outperform the Odyssey to get paid for taking that additional risk. So that's kind of the big picture. I'm going to pause again and see if there are any questions. Okay. Next page, please. I'm going to give you a very quick overview of our house views. I should mention, everything I just said is actually written out in words in our real estate primer, which is available to you. It explains all of this. And then the house views is something that we publish in the spring and the fall. It's a 70-page deck explaining what we see going on in the market. It's mostly charts. And we distill from that. We're going to do an hour-long webinar that is recorded on Tuesday. If anybody wants to know more about the real estate markets, we are your consultant. We're happy to provide that context. But I'm going to give you guys just a 5-minute view today. So next page, please. So real estate is kind of bouncing along bottom. And it is, like, as I said, a good time to invest. But there's also a lot of turmoil and noise. And often, as happens, when it's a good time to invest, doesn't necessarily feel like a good time to invest. So the real estate cycle turned very abruptly in the beginning of 22 with a big jump in interest rates in the wake of COVID as they unwound the ZIRP, the zero interest rate policy. And that it took about 2 years, but real estate trading prices fell dramatically because the marginal asset is bought by a levered buyer. And so 10-year rates, 5 and 10-year interest rates are big determinants of real estate returns. So prices fell. And then what happened was you had all these leveraged buyers out there. And with borrowing rates being higher, when they went to replace an existing loan, the new loan was actually smaller. The income on the property couldn't support as big of a loan. So this is creating a lot of balance sheet problems that haven't been resolved. About a third of matured loans are not resolved, are not paid off, and many loans have been deferred. So there's a huge balance sheet challenge, and so you can make money solving that problem, whether it's secondary recapitalizations, distressed buyers to the extent there are forced sales, and that can happen anywhere in the risk spectrum. So the combination of being around the bottom of the cycle and having a lot of balance sheet distress does create opportunity. The other thing that happened was we had pretty significant US policy changes in 25, right? At the beginning of the year, it looked like the cycle was starting to resolve. And then we kicked off this whole wave of uncertainty. And it's uncertainty in a lot of different directions. But for example, the tariff uncertainty is really backing up industrial warehouse leasing, nowhere more than Southern California because it faces Asia and that trade is subject to significant tariffs. So the uncertainty again slowed the market. We are now starting, every time interest rates dip, we are starting to see some recovery, but also we've been at this for 3 years. So we're seeing more and more lenders just say, look, I gave you time, you didn't fix it 3 years later, like pay me back. So that is creating an uptick in activity, and the non-core funds are now calling capital 22% above the long-term normal because they're really seeing opportunity and things to do. So that's the big picture. I'm going to talk about a few more numbers along the way. Let me know if you have questions. Next page. Whenever you have a big dislocation, it affects transaction volumes pretty dramatically. And we had, with the zero interest rate policy in the US, trading absolutely soared in 21 and in the beginning of 22. And then interest rates went up and it fell precipitously. It is only this quarter, the third quarter of this year, that trading volume has gotten back to normal levels. And I think that's because of the dip in interest rates. And as interest rates are more volatile now, it's going to rise and fall, bump along, probably close to the normal. It's a reasonably liquid market. In the US, for a bunch of technical reasons, the open-ended funds are who are the natural core buyers, who are the takeout for the non-core players, are not buying very much right now. And that is a big part of what is depressing volume, is missing core buyer. That is also true in Europe. Europe's volume is depressed and it hasn't come back as far towards the line, which is the long-term normal. And Europe obviously is multiple countries. UK volume is doing quite well. Germany is really missing its core buyers, and Germany is the largest trading market in Europe, or has been. Mm-hmm. So that has kept Europe trading a little more depressed, but it's a mixed bag with UK doing much better and Spain. France is slower, Netherlands are slower. So we look at transaction volumes just generally to understand what's happening in the market, but it's also interesting to have this context when you think about the fact that you are selling assets and have been selling assets for the last, we had a program that we started when sales were at the peak. Mm-hmm. We said 3 to 5 years, not because at that moment it was going to take 3 to 5 years, but because things happen, and lo and behold, things happen. So we're more in the 3 to 5 year execution plan because of the market volumes being slower. Mm-hmm. So next page, please. This is the 3 charts are US, Europe, and Asia. And the total bar is the return from the core buy and hold real estate strategy. The black line is the current income, and you'll see that stable, and it's actually gradually growing over time, which income from real estate, unlike fixed income, does grow. And you'll see a big swing in values driven by the big swing in interest rates. The one other time that happened was in the global financial crisis. If you look at this over a longer time horizon, you'll see a big swing then too. The light gray is the forecast. And the general forecast is for interest rates are still going to be bouncing around, but they're not projecting any kind of big swings. So as we move forward without the moving interest rates, income becomes a much more important component of total return, and income growth is as well. And as we move into a more uncertain economy, focusing on the quality of the income is very important. So next page, please. And this is my last page. This lays out the income. The left chart is the US, the right chart is Europe. The light gray bars are 2007 to 2014, so a longer term horizon. And they show income growth by property type. So you have industrial, multifamily, retail, and office, the big 4 food groups. The black one is 22 to 24. So there was this big surge in income after COVID. Some of that was fueled by the big shift in demand for industrial and e-commerce, which got another boost up during lockdown. Some of that was the fact that people moved a lot out of towards the Sun Belt to secondary locations. There was a lot of multifamily development that led to surging incomes. That was just 2 years versus a much longer period before it, which is the black one is part of the gray one. And it is important to note because the green one is the next 5 years, and that's the projection. It feels so much worse than the recent past, but it's actually better than the long-term history because we have consistently growing incomes. And that feels so much worse is really important because remember when I said it's the right time to invest, even though it doesn't feel like it? This is one of the reasons it doesn't feel like it. But we still have positive and growing income. And even in the downside scenarios, which are the orange dots, it's still positive and growing. This is a growth of the income, not the actual income itself. And except for office, which is in the US, which is still undergoing this transition as it digests work from home. So the outlook for real estate is decent growth, admittedly on the income side, higher than it's been in many cases over the next 5 years in an environment where there's tremendous economic uncertainty. And we are generally pointing people to products that have more resilient income, and that would be residential. It can be industrial as we're designing portfolios. So that's my quick version of the house views. I don't know if anybody has questions on the marketplace.
Go ahead, fire away.
Thank you so much. I wanted to find out if we could get a link to the webinar.
Yes.
Okay, great.
I'll have
Thank you.
to figure out how to do that. Terry. Yeah. It's on Tuesday morning, but it's recorded.
Okay, great. Oh, great. Thank you.
So my question would be thinking about the arc here. So given the structure review, I think you gave to us 3 years ago, and then bringing on Terry and everything else, in terms of the turnaround, in terms of our posture towards real estate, are we, if you use baseball maybe as an analogy, how early are we still? I know we still have some property dispositions, things we're trying to work out, and I know we've made some shifts, but like where are we kind of in our, repositioning since the lost decade, if you will?
Very big picture, the ocean liner has absolutely turned.
Okay, good.
And if you want to rattle off some, you're very far along
Okay.
from having a portfolio that was super concentrated and underperforming to at the end of this year having just a bit left to work through. It's not zero, but
Right.
it's much less than it was. And most of that capital is getting redeployed to these diversified open-ended core funds that'll be much more likely to deliver you the Odyssey portfolio with the diversification that I remember I said is like the best risk mitigator.
Right.
We're about 3.6% invested in core versus our 5% target.
Okay.
It's a good time to have dry powder. So we think that'll also help. And then same with non-core, we're about 1.3% against a 2% target. So we think we're spending a lot of time on selection and making sure that we are working with managers we believe have all of the elements that identified here for understanding risk and being able to perform in this new environment.
Okay.
So yeah, we feel pretty good about the direction we're going in.
Well, good. That might be one less gray hair for me then on that part. Any other questions from the committee there, Trustee Ginsburg at all? And then we'll wait for Trustee Martin to come back and we can approve the minutes. And then we can probably break a little early before the 9 a.m. meeting at that standpoint. So I do want to just say thank you, Margaret, obviously, for coming. I always enjoy your presentations through there. I think having been thrown the hot potato as a freshman in terms of real estate, real assets thing, that's through there. It's nice to know that we have made the turn and making the move there. I think that's important. Real estate, I think, should be the consistent contributor to overall returns that we've kind of been lacking. So I imagine John, as proud as he is, as the benchmark beating that we've done so far, it will be nice to see real estate make a contribution towards that in the future. So if we get Trustee Martin here, I don't know if she's eating a bagel or what have you, we can approve the minutes and then we'll adjourn to the 9 meeting. Thank you, Margaret.
Thank you, Chair.
Thank you,
Jones.
Chair. Yeah.
Thank you, trustees.
Yeah.
Yeah, welcome, Mr. Martin. Yeah, no,
Thank you. I wasn't planning to be here tonight.
no, that's okay.
Okay.
All right.
Sorry.
No worries. So then if we, for regarding the minutes, were there any amendments or changes to that at all? Could I have a motion?
So moved.
Do I have a second?
Okay, Mr. Jones,
Aye.
Ms. Langton.
Aye.
Ms. Martin. Aye. Okay, the motion passes unanimously.
And then before we adjourn, as I mentioned, as a freshman in 2021, this was the committee that was kind of hot potato to me. I figured because nobody else wanted at that level. And one of the first calls I got during that period was from Jim Rice, who had reached out to me and kind of welcomed me to the board. And we kind of had a little bit of a chat about the state of the real estate thing, because again, I was new to it from an asset class perspective, as well as being a new board member. And I just remember how genteel he was, and he was great and direct at kind of answering questions from someone who was clearly a novice. He didn't make me feel like a novice. He kind of made me feel like, hey, that's a really good question. That was through there. And subsequently, the cadence for the real estate committee is usually twice a year. So it was a real heavy engagement. But I always appreciated the kind of pre-meeting conversations and just, hey, what do you think? What do you think? Giving an opportunity to kind of take my feedback about, hey, I think it might be good if we positioned it this way to share with the other trustees. And so likewise, I was disappointed to find out that he had fell ill, likewise, and, not familiar with his prior valiant battle with cancer previously, and then having had made a return to the office and was free. I was really disappointed to find out that he had subsequently had taken it on again. So, in this space where you get a chance to work with people, I know people of the team kind of worked with him every day for a long time, but in this position where you get a chance to appreciate the professionalism and the personal conduct or the personal touch that you have, Jim passed away a couple of weeks ago. I just wanted to make sure that we acknowledge his contribution both to LACERA. I know he's even more dearly missed by family and friends and those who loved him and knew him for a long time. But I did want to adjourn the meeting with a particular acknowledgement for Jim and his service there. So without further ado, we will break until the 9 o'clock meeting.